Exchange rate, the price of a currency in terms of another currency or currencies. Monetary Policy Committee, MPC, is a committee in the Bank of England, who control the interest rate in order to achieve the inflation target. The interest rate and the exchange rate are directly related. How is it determined? The values of the currencies in most countries are determined by the demand and supply for them. What influences demand for a currency? If the country's products are internationally competitive, more people will buy pounds in order to buy the country's products, and not a lot of money will be exchanged for exports. Increase in incomes abroad will mean more products are bought as exports and more money will be needed to supply these products. Increase in incomes at home will increase demand for imports, so it will increase supply of pounds and will cause lower value of pound. A rise in UK interest rate will mean that more people will want to open accounts in UK, which will increase demand and values of pounds. A fall in the value may discourage some people as they come to use fast advantages, but may not have any effect if foreigners think that lower exchange rate is going to increase growth rate. Also, a rise in the exchange rate will mean lower demand for exports, which will reduce inflationary pressure, and then the Monetary Committee is going to reduce the interest rate. High investment in the country will mean high demand and higher value of the currency, but higher investment abroad will mean just the opposite. Speculations: the buying and selling of currencies in order to make fast profits. This means that good expectations about the country's currency are going to make consumers buy and reduce a fall if it is decreasing and cause a rise if it is increasing. Government intervention: the government can influence its currency exchange rate by buying and selling their currency or limiting the supply of their currency. The effect on the country and its balance of payments: a fall in the exchange rate will increase demand for exports as the firms are usually going to keep the same prices, which will enable them to achieve higher profits, if demand is elastic. The problem is that higher interest rates can cause higher cost of imported raw materials, which will increase the cost of production and may lead to rise in prices, which will mean higher inflation. Also, it will reduce the demand for imports as the cost of imports will be higher. This change makes the country more competitive and helps it achieve a current account surplus of the balance of payments. On the other side, higher exchange rate will mean less exports and more imports as the prices of the exports will rise and imports will fall, which can cause a current account deficit if demand is elastic.